Hey everyone, welcome back to Stock Market Secrets Unlocked India Edition. This is day 4, and today we're going to make investing even easier. In the last session, we learned how to build your first stock portfolio and how to choose your first set of stocks. But what if you don't have the time, experience, or confidence to study companies yourself? What if picking stocks feels too difficult or risky right now? The good news is, even if you don't research individual stocks, you can still invest and grow your wealth. You can grow your money through mutual funds, SIP, and ETF. Today, we will understand all three in the simplest way. Let's start with mutual funds. A mutual fund is basically a big basket of many investments. Imagine trying to buy 20 different stocks yourself. It takes a lot of time, effort, and money. But with a mutual fund, a professional fund manager collects money from thousands of people and invests it into a mix of stocks, bonds, or both. This gives you instant diversification, expert management, and the ability to invest with small amounts. For example, if you invest just 500 rupees in a mutual fund that owns Reliance, HDFC Bank, and TCS, you automatically become part owner of all these companies without buying each one separately. Now let's understand the types of mutual funds. The first type is equity funds. They invest mainly in stocks and are good for long-term wealth creation. Examples: SBI Blue Chip Fund or Axis Mid Cap Fund. The second type is debt funds. They invest in government or corporate bonds. They are less risky but usually give lower returns. Example: HDFC Short Term Debt Fund. Then we have hybrid or balanced funds, which mix equity and debt. These offer moderate risk and stable growth. And finally, index funds. They simply copy an index like the Nifty 50 or Sensex. This means their returns are similar to the market. Index funds are great for beginners because they are low cost, simple, and easy to understand. Now let's talk about a popular term, SIP. SIP means systematic investment plan. It is like setting an automatic monthly payment into your mutual fund. You can start an SIP with as little as 500 rupees or 1000 rupees per month, just like a small EMI. But this EMI is helping you grow rich. SIP work because of consistency and compounding. Even small regular investments can grow into big wealth. For example, if you invest 2000 rupees every month for 20 years at an average return of 12%, you may get almost 20 lakh. This is the power of compounding. Your money grows, and then the growth also starts growing. One big benefit of SIP is that they help you handle market ups and downs. You don't need to worry about whether the market is high or low. When the market falls, your SIP buys more units because prices are cheaper. When the market rises, your SIP buys fewer units because prices are higher. Over time, this helps average out your cost. This is called rupee cost averaging. Instead of trying to time the market, you let time work for you. As the saying goes, time in the market is more important than timing the market. Next, let's understand ETF, exchange traded funds. ETF are similar to mutual funds because they also hold a basket of stocks. But the main difference is that ETF are traded on the stock exchange like normal shares. So, you can buy and sell them anytime during market hours. For example, the Nippon India Nifty 50 ETF follows the Nifty 50 index. The ICICI Prudential Gold ETF invests in gold. ETFs have low costs, high liquidity, and market linked returns. A simple way to remember the difference: mutual funds are like sitting in a bus. You buy a ticket and let the driver take you. ETFs are like driving your own car. You choose when to buy or sell. To make this even clearer, here's a quick comparison. Mutual funds are managed by fund managers, while ETFs usually follow an index. Mutual funds are bought through an AMC or an investment app, while ETFs are bought directly on the stock exchange. Mutual funds have slightly higher fees, while ETFs are usually cheaper. If you're a beginner, mutual funds, especially SIP, are the best place to start. ETFs are helpful once you gain confidence and want more control. Starting with mutual funds is very simple. First, open an account on apps like Grow, Zerodha, or Kuvera. Second, choose a beginner-friendly fund like a large-cap index fund or a good blue-chip fund. Third, start your SIP. Even 500 rupees per month is enough. Review your investment every 6-12 months. Don't chase hot funds that everyone is talking about. Look for consistency, low risk, and low expense ratios. Here's a quick example. If you start a 1000 rupees SIP in the Nippon India Nifty 50 index fund and continue it for 15 years at an average return of 12%, your total investment of 1,80,000 rupees can grow to over 4,90,000 rupees. That's the kind of growth long-term investing gives: slow, steady, and safe. Here's a pro tip. If you want diversification plus tax savings, check out ELSS mutual funds. These help you grow money and also give tax benefits under Section 80C of the Income Tax Act. So you save tax and build wealth, a win-win. Let's quickly recap what we learned today. Mutual funds let you invest in many companies at once. SIP help you build wealth through small, regular investments. ETFs give you trading flexibility with diversification. And the most important rule is start small, stay consistent, and let compounding work its magic. This is how you make your money work for you. On day 5, we'll learn why stock prices move, why they rise, fall, spike, or crash. We'll see how news, company performance, and investor emotions affect the market every day. So make sure you follow, subscribe, and stay tuned. Your journey toward financial freedom has just begun. Thank you for watching, and I'll see you in day 5 of Stock Market Secrets Unlocked India Edition.